Coming up on Market to Market. With $1 trillion in the balance, NAFTA negotiators feel the pressure from all sides. And an antibiotic labeling battle goes under the microscope. Those stories and market analysis with Angie Setzer. Next.
Probably pretty reasonable bug food.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today. This is the Friday, October 13 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Even as political headlines and natural disasters bombard Americans, consumers remained optimistic enough to make purchases beyond the ones needed to rebuild. New cars acquired in the wake of recent hurricanes ran retail sales 1.6% higher last month. Without automobile purchases, retail sales bumped up 0.5%. A surge in energy prices moved the Consumer Price Index up 0.5%. When the pain at the pump is removed, core inflation traveled 0.1% higher. This week, rural Americans had a lot on their plate. President Trump dropped subsidies for the Affordable Care Act. EPA Secretary Pruitt announced the end to the Obama-era Clean Power Plan, and Northern California wildfires burned an area the size of New York City, taking more than 30 lives. Back inside the Beltway, trade negotiators in Washington felt the heat as well. With hundreds of billions in the balance, 2 extra days of discussion were added to the battle over the 2-decade-old trade pact. Paul Yeager has more.
President Donald Trump welcomed Canadian Prime Minister Justin Trudeau to the White House to discuss many topics, chiefly the North American Free Trade Agreement. NAFTA negotiations entered round 4, and agriculture was likely to be the focus of the session. The president is holding his position of potentially walking away from the pact between Mexico and Canada that erased barriers between the countries and led to an explosion of trade. Trump wants more than minor tweaks to the existing pact.
I think Justin understands this. If we can't make a deal, it'll be terminated, and that'll be fun. They're going to do well, we're going to do well, but maybe that won't be necessary. But it has to be fair to both countries.
The Prime Minister of Canada sounded the optimism bell in his appearance in Washington, D.C.
I know how good NAFTA has been for millions of citizens of Canada, of the United States, and indeed for New Mexico. I know that there are opportunities to significantly improve this trade deal in ways that will benefit citizens right across the United States.
Late last week, the nation's biggest business group, the U.S. Chamber of Commerce, said withdrawing from NAFTA would be a, quote, political and economic debacle, end quote, that would cost hundreds of thousands of U.S. jobs. This week, the nation's largest agriculture group, the American Farm Bureau Federation, announced they were joining a group called Farmers for Free Trade in an effort to have a seat at the table in working out trade deals.
You can't paint these trade agreements with too broad a brush. You can't say a trade agreement is totally bad because there are certain aspects of the economy that benefit from these trade agreements, and certainly NAFTA has benefited agriculture. There's no question about that.
The former Secretary of Agriculture and current President and CEO of the U.S. Dairy Export Council says agriculture combined with the food processing industry consists of 23 million jobs, more than any other industry impacted by NAFTA. USDA says the impact of just agricultural trade under the pact is nearly $250 billion annually.
From the dairy perspective, the problem would be that we would lose the opportunity to really open up that Canadian market. I think there is a lot of political pressure taking place in this country and in Canada for changes in that very closed system. We would also, unfortunately, give the European Union yet another opportunity, as we did when we pulled out of the Trans-Pacific Partnership, to move into the void that we would create.
Vilsack and others in the dairy industry would like to see the elimination of Canada's supply management system, which is a closed market for the Canadian producer. Canada also wants greater access to the U.S. consumer. For Market to Market, I'm Paul Yeager.
Various groups have encouraged consumers to ask more about their food. Labels like antibiotic-free have entered the lexicon to help sort out the details. However, questions have been raised about the overuse of such monikers. Colleen Bradford-Krantz has more.
Advertising campaigns in 2016 by some of the nation's largest poultry producers illustrate how central questions over antibiotic use have become in the pursuit of customer loyalty.
We take some unexpected extra steps to raise healthy chickens with no antibiotics ever.
For example, thyme. It's part of our 100% veggie diet that we feed our chickens and helps support their immune system. And we don't need to add antibiotics to their diet.
I'm no marketing guru, but this guy is.
He's from Madison Avenue. He likes to say things like, raised without antibiotics.
That's a phrase he invented to make chickens sound safer. And it doesn't mean much because by federal law, all chickens must be clear of antibiotics before they leave the farm.
I got more. Mom approved. Caffeine-free.
Clinical pharmacology professor Hans Kudsi, formerly with Iowa State University's Veterinary Diagnostic Laboratory and now with Kansas State University, worries that companies are sending conflicting messages as they struggle to address this complex issue with customers.
I'm concerned that increasingly this is becoming an area of product differentiation to the extent where it potentially could start a protein war, where poultry companies are trying to distinguish their product from say, swine production companies or beef production companies by making statements about their product being antibiotic-free. All meat is considered antibiotic-free based on the fact that producers observe these withhold periods and there's the testing at the time of harvest.
The most recent federal report shows that only 26 of more than 7,000 animals randomly tested at U.S. packing plants, about 0.4%, had higher than allowed levels of substances such as antibiotics. None were poultry. Yet, according to a National Chicken Council 2015 survey, 73% of Americans believe antibiotics are present in most chicken meat. For meat producers, this common misconception can clash with the old adage, the customer is always right. In an attempt to allay fears that antibiotic resistance in humans may increase if the same drugs are used too frequently in animals, the federal government enacted new rules in January 2017 prohibiting the use of so-called medically important antibiotics to promote growth. Despite the new regulations, veterinarians are still able to approve the use of these drugs for sick animals. Producers may find themselves having to decide between treating sick animals and avoiding customer aversion to the word antibiotic.
I think the interesting thing is how we relate to animals in our home versus how we relate to animals in livestock production systems. I think most people, including our household, would consider our pet to be part of the family, and you wouldn't for a moment consider withholding antibiotics from a member of your family if the animal or your child requires an antibiotic.
Maryland-based Purdue Foods, the nation's #4 chicken producer, advertises so-called NAE meat, or no antibiotics ever, following a gradual change in how bird health is managed.
The use of antibiotics in food animals has become pretty complicated. It's definitely a concern to consumers.
Simultaneously, Mississippi-based Sanderson Farms, the #3 producer, explains it uses a class of antibiotics intended only for animals.
The marketing gimmick.
Sanderson's ads make the point that implying all antibiotics are bad is a misleading marketing gimmick.
I will tell you it's been a hard decision. It's been difficult. We feel like we're swimming upstream, to tell you the truth.
Sanderson Farms carefully measured consumer reaction to the ads rolled out in August 2016 and discovered that about 65% wanted to learn more.
We've always believed, let's tell the customer the truth. Let's tell the consumer the truth. The truth will stand the test of time, and that's what we're doing with this issue too.
According to the National Chicken Council, the average chicken mortality rate at commercial broiler operations was 4.5% in 2016. That percentage has trended upward since 2013, in part, experts say, due to the effort to use fewer antibiotics. Sanderson said its 2016 mortality rate was 4%. Purdue said that information is confidential, but added that their rate was at or below the national average. Kansas State's Kudsey believes all livestock producers should be transparent about how many animals they start with and how many make it to market.
It's important that we are transparent about all aspects of those production systems rather than just cherry picking.
Sanderson Farms, whose contract farmers raise 10 million chickens a week, uses antibiotics in the hatcheries and animal-only medicine in feed, stopping in advance of the mandatory withdrawal period. Otherwise, the medically important antibiotics are only used to treat sick birds or flocks.
Our vets have all taken an oath to treat animals and to keep animals healthy. We have heard from other vets and other companies that they respect our position.
Purdue Foods has been working since 2002 to provide chicken houses where birds are separated so they can be advertised as no antibiotics ever. In 2008, Purdue stopped using antibiotics in feed for growth promotion and redesigned poultry buildings to reduce bacterial growth. By 2013, antibiotic use in the hatcheries was ended, and different vaccines were being used.
Over 3/4 now of our chickens are raised with no antibiotics ever.
The treated birds are sold to another company.
It's a delicate balance between balancing the needs of the animals and ensuring that those needs are met, balancing the financial considerations and the needs of the producer in order to be able to make a living, and then also balancing the consumer expectation, making sure that from an ethical standpoint that those animals are raised in a way that they have a good life and that they don't suffer and that they're free of illness.
For Market to Market, I'm Colleen Bradford-Krantz.
Next, the Market to Market report.
Not even a 50-mile-long barge traffic jam caused by the closing of Lock and Dam 52 could move trade mired in harvest doldrums. However, one USDA report made for some volatility. For the week, December wheat lost 4 cents, while the nearby corn contract moved 3 cents higher. The October WASDE report revealed a yield reduction and potentially tighter new crop ending stocks. The November soybean contract jumped 26 cents on the news and closed 28 cents higher for the week. December meal added $9.40 per ton. December cotton fell 22 cents per hundredweight. Over in the dairy parlor, November Class 3 milk futures soured 38 cents. The livestock complex was mixed as the December cattle contract gained 20 cents and nearby feeders shed 75. The December lean hog contract rose $1.27. In the currency markets, the U.S. dollar fell 71 basis points. Crude oil rose $2.16 per barrel. COMEX gold rocketed $29.70 per ounce. And the Goldman Sachs Commodity Index put on more than 10 points to finish the week at 402.70. Here now to lend us her insight on these and other trends is one of our regular market analysts, Angie Setzer. Angie, welcome back.
Hi, thanks for having me.
In case you want to go over things again, you can download or listen to our Market Analysis and Market Plus podcasts anytime online at iptv.org/MTOM. Angie, let's take a look at this wheat market. Dropped another 4 cents despite the overwhelming support coming from the soybean market. What happened?
Well, wheat is struggling. You know, everyone continues to, speaking the obvious, but the USDA continues to come out and kind of counter the ideas that we had midsummer that we were going to see a pretty significant production shortage. So they've come out and said, wait, no, production's a bit higher than we'd anticipated for spring wheat, you know, and then on that you have to counter with the continued concerns and reduced demand. The USDA report out this week actually increased carryout when traders were anticipating it to fall off. I would venture, though, a lot of that was due to reduction in feed use for cattle, and I think a lot of that would have to do with the fact that you're seeing a market shift in the southern plains with the introduction of that VSR, that you could see a bit more, especially with the increased supply of corn availability. You know, elevators are probably going to want to hold on to a little bit more of that wheat. You've got a different sort of feed market set up. We did see feed and residual use increased in corn for about the same amount, 25 million bushel. So it was a little bit of an offsetting thing. We still have those huge global stocks to worry about, but 48% of them are sitting in the hands of the Chinese. So wheat wheat is suffering from Groundhog's Day more than anything.
Yep, it's just it's the same day again and
over
again
and over and over again.
Now, given the fact that we're down here at 440, 445, 435, is there anything that's going to bust us out of that range short term?
I would say our downside risk is mostly limited now. We're getting into the new crop production period here as we work our way ahead. We're starting to see some interesting developments in the cash market in the spring wheat. The USDA has come out and said production is large. However, delivery and cash grain availability is starting to kind of indicate that maybe those bushels have been put away. Seasonally, of course, it's harvest, so we're focusing our attention on moving other things. But we're going to start paying attention to how many acres are going to be planted. I wouldn't be the least bit surprised to see winter wheat acres actually at a record low. This last year we were at the lowest level since 1910.
Yeah.
I would not be surprised to see that reduced even further. And so we're going to have to start paying attention to the production issues in Australia. The USDA is still about 3 million metric ton higher than what most folks are saying we're going to see out of the country, and seeing what we're going to have for next year. So we know what last year's given us. We know we're going to have some reasonable carry out and carry over into next year, but pretty soon we're going to start shifting into that production market for the Northern Hemisphere, and hopefully that'll give us a nice kick in the right direction.
You bet. At least give an incentive to move it upwards.
Something, yeah.
Now, as we take a look into the corn market, I want to jump into it with a great question from one of our followers on Facebook. This is from Dan in Illinois, and we encourage all of you to submit questions to us on Facebook and social media. Dan is noting that the corn market performed well following a bearish report. Was that because of strong technical support in the 345 area, or did beans just provide that spillover support?
Well, I think the report that we got from the USDA this week, it gave us the most bearish information the USDA is capable of giving us. Basically, it came out, it said, yep, yield was increased, acreage was down a little bit, here's your production number. Old crop carryout was lower, as we'd seen evidence in the quarterly stocks report at the end of September. So now we can start to focus on demand. And we did peak below that 345 support level that we had seen prior to the report, put in a new contract low, and to be able to turn around like we did was pretty beneficial, and did open the door for some folks to come in and maybe start buying, because that concern over something extraordinarily bearish kind of was removed from the market with that report. It's going to be difficult. It's just like wheat. It's Groundhog's Day. We know that we have a lot of supply. We know we have to try to encourage significant demand increases when it comes to U.S. corn on the export front. We have the NAFTA boogeyman, hiding behind the curtain there, the 800-pound gorilla in the room right now with that. We saw extraordinarily large export sales this week, almost double what the mid-range was for expectations. So we are seeing that demand kind of come in. There is reason that we should see support in corn now, but there isn't really reason that we should go up much higher until we see
combines are still running.
Exactly.
Yeah, it's harvest.
And yield reports, as much as I hate to say it, have come in better than expected. Even in the drier areas of Michigan, where a lot of my customers struggled with bean yields, they have found now that we're getting into corn, that corn did pretty decently for the year that we had with the dry weather towards the tail end. So we do have the crop there, but we know that. Right. I mean, the surprise came in August. We've been digesting that surprise from the USDA for about 2 months now. That's behind us. Now we can start focusing on the demand side of things and what's going to happen in South America. And the continued low prices that we're seeing here in the U.S. right now is going to discourage an increase in production down there, and it actually will probably be beneficial to us as we work our way through the year, through the crop year, to see that if we can see some sort of production issue develop, perhaps our last half of the marketing year exports can pick up.
Okay. Now, the big story this week has been the soybean market.
Course, yeah.
26 cents, 28 cents higher, closed the November contract over $10.
Yeah.
Angie Setzer, what is this setting us up for?
Not a whole lot of anything.
Okay.
I mean, I don't want to sound like I don't anticipate us. There could be some continued strength. Sometimes taking away the fear in the market, which is what we got from the USDA report this week. We didn't get that huge yield increase. A lot of folks were thinking we were going to see yields above 50 and see a 1 million acre increase due to FSA information. Well, we saw that acreage increase. Yep. We saw the yield reduction, though, and then we got to see that the old crop ending stocks reduction help to lower our new crop expectations. Right now, a lot of folks are really excited. The USDA has a tendency, 24 out of the last 34 years, they have overestimated carry out in the October report. Now, of course, 10 out of the last 34 years, they have underestimated carry out. So
okay.
But probabilities point in that direction, or at least that's what traders are looking at right now. And yeah, sometimes removing the fear or removing the chance of bearishness from a market is more bullish than anything. And I think that's what we saw in this week's reaction. I worry, though, that as harvest progresses, you're going to see a continuation of farmer selling pressure on the market. And I can't at this point, without some sort of production issue, which La Nina chances were increased this week up to 65%, 50 to 65. Yep. But without a South American issue, I really don't know why we would put in new contract highs.
Okay.
And we're within shouting distance of the old ones where we stand right now.
Okay. So good selling opportunity right off the combine for growers that have made that decision.
I would say you got to gift bow on top and everything.
All right. Now let's take a look at the livestock market, Angie. We've seen live cattle show a little bit of resilience here, or at least not a collapse. Where's that market going here as we get into the winter month and temperatures cool?
We saw some really interesting thing with weights this week. Weights coming in lower than what we had seen prior, which is counter-seasonal and really kind of surprising for having been stuck in a bearish market trend. Typically you'll see farmers hold the cattle back. We have started to see the cash market firm up a little bit with some offers out there and some folks or some bids out there, and the offers are a little bit far apart. Packer margins have remained good. Yet they've actually increased significantly as the market has fallen off. So the Packers have a little bit of money I think they could give up. I think that firming in cash and the lack of increase that we've seen in the cattle on feed. I mean, we've really slowed down the amount of cattle that we're feeding, or at least the growth in the amount of cattle that we're feeding. The USDA yesterday, or in their report this week, came out and said they anticipate exports to China to increase in 2018, something like 15%.
Yeah,
I believe.
Fairly sizable number.
That's a chunk. So the demand remains good. Our dollar is helping to encourage folks buying from us. And at this point in time, I think we've established where the low end of the trade is, and would probably continue to see some support in that just because, again, Packer margins remain solid. And obviously with the lower weights that we've seen, we're not holding them over a whole lot.
Yeah.
So it's something to definitely keep an eye on.
Given that's the trend, potential strength in live cattle, the low side is in on the corn market as we get into harvest season. Do you see feeder cattle moving big one way or the other?
Not really. I think they're going to stay strong. I think the desire to get a hold of feeder cattle is a good one. Corn remains cheap. Yeah, we've seen the low end put in, but it's still pretty cheap. And it's not really going to move too far one way or the other for the next couple months. I don't really see why you would need them to back off too awful much at this point in time.
Now, we've got the lean hog market finally found a little bit of strength this week.
Yeah.
We're up $1.27. Bean meal, of course, also much higher, $9, $9+ to the upside. For hog producers that are watching this market, how much more strength do you see here as we climb into this fourth quarter?
It's tough because right now that increased kill capacity is really, I think we had something like 124,000 head more of hogs killed this week than a year ago at this time.
Yeah.
I mean, it's extraordinary. So we have a significant supply of hogs coming into the marketplace, or meat coming into the marketplace. It really is going to weigh heavy on the market, I believe. Any sort of strength, we saw the cash values fall off a little bit today. So any sort of strength needs to be taken advantage of, I would imagine, or at least I believe. That kill capacity is there. We're obviously meeting it. It's a great opportunity for the guys who have hogs to increase that production, but of course, increased supply tends to weigh a little heavy on prices. So it'd be something I would watch, take advantage of any sort of rallies, because I think long-term the market's probably going to flatten out a little bit. And just like in corn, that NAFTA thing, we really have to watch what's going on because Mexico is a large pork importer.
And we also heard news on Friday that South Korea and the U.S. have agreed to talk about their free trade agreement, which South Korea is a fairly large pork buyer. So we do have a lot of those potential headwinds or risk factors, I suppose, in the market?
It's a headline risk. A lot of people say headline risk gives you an opportunity, which is true for speculators for the most part. Headline risk tends to be have a negative impact for farmers because the market does not like unknowns.
Now, as we talked about bean meal, big jump this week. Do you want to be locking in feed, or do you want to see where beans settle out after this crazy week?
I would see where beans settle out after this crazy week. I think we got a lot of excitement on Thursday. Again, that removal of fear kind of introduced this rush to the upside. I think you're going to have an opportunity to probably get a hold of some long-term feed, a little bit cheaper, but definitely keep an eye on the Brazilian weather. It's a little dry in some areas, although Mato Grosso has received some decent rains and is expected to.
Okay.
It is important to watch, though. If we see La Nina develop and dryness really kick in, then
get some locked in.
Yeah.
Well, Angie Setzer, thank you so much for taking the time to join us.
Thanks for having me.
You bet. That wraps up the broadcast portion of Market to Market. However, we will keep the conversation going, including answering more of your questions during Market Plus, available in podcast and video form on our website. We've also launched our own YouTube channel. Check us out at youtube.com/market-to-market and subscribe today. You'll get notified when Market Plus and our feature stories are posted. Join us again next week when we'll examine solutions to food insecurity offered by 5 former U.S. Secretaries of Agriculture. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.